Welcome to Make Your Money Matter with Brad Barrett, the show that aims to change the way you think about wealth management. Brad is a financial advisor, established radio host, and author of Retire Right. He is a managing director and partner at One Capital Management, an SEC-registered investment advisory firm managing over $4 billion for clients across the nation. Brad and his team are dedicated to helping clients protect and preserve their assets so they can reach their investment and retirement goals. And now, your host of Make Your Money Matter, Brad Barrett.
Well, welcome in to Make Your Money Matter. I'm your host, Brad Barrett. I'm also a managing director and partner here at One Capital Management. Friends, it's good to be with you again. As I stated about a month ago, we've had a little bit of a studio disruption. We're building a new studio here at our offices here at One Capital Management, so I apologize. We have not been doing the weekly podcasts, and we've done a few of them, but I want to come back to you today and say we're set, we're here, and what a day to come back. I'm actually recording this on purpose on Monday, August 5th. You will likely see this in your inbox in the next day or two. And I want to talk about what we're seeing today. Now, it's fresh in the morning and we're coming off of last week's as well. I want to talk about market volatility. I want to share with us what that means for our overall retirement plan, our investment life, but also what it says about us as individuals and how we perceive things. Because as I share often, context is everything. So stay tuned today. But before we get started, make sure to go to our website at onecapital.com. You can click and download the media tab for our show. You can also download the Make Your Money Matter show on any platform there's a podcast, whether that's Spotify or SoundCloud or the Apple iTunes app on your phone. And as always, I ask, leave us a message, give us a review. It's always good to hear your feedback. And with that, let's get started. So out of the gate, I just want to mention this right first and foremost, that we're talking today about a lot of things when it comes to investing, but I really want to focus on the fact that, like many of you are seeing, markets are down. Now, we haven't seen that this year. We've seen some volatility thus far in 2024, but this whole, oh my gosh, the stock market's crashing, it's down almost 6% from its high. We'll talk about that in context, but I want to say something loud and clear for everybody right out of the gate. Within the first 2 minutes of this show, the market, what you and I would call the stock market, most of us refer to it as the S&P 500. The market over the past 10 years, just this last 10 years, has dropped 5% or more 17 times. Over the past 10 years, the market has dropped 5% or more 17 times. Now, many of you might be going like, okay, Brad, that doesn't sound like a whole lot. Well, think about it in context. That's over one time a year average. It's dropped more than 5%. Look, right now, this last week or so, the market has not been great. But if you look at it in context, it's basically given back gains, or call it house money, whatever you want to call it, from January 1st. Look, I want to just say this openly as an investment manager of nearly 19 years and working with clients, that the stock market is volatile. It's a part of investing. And I think more than anything, we have to remind ourselves of this. If you want no volatility or zero volatility, you can put your money in your backyard. That's cool. But if you want to build wealth over the long term, that's the key right there, long term. And we're going to talk about that as well in context here today. We have to accept the volatility sometimes in the short term so that we are rewarded later. And a lot of that has to do with how you feel about things, how you perceive what's going on in your world. Also, who you're working with. For anyone who's listened to our show over the past 4 years, or who work with me or my advisor partner, Toby Rodriguez, here at our firm, or any one of our great credentialed, experienced, and fiduciary advisors here at One Capital Management, you have to know that I speak heavily on having counsel, having someone in your corner to say, hey, I saw what was going on Friday. I saw what was going on today. No more than 5 minutes, but just walk me through what you're seeing. Help me out here. Remind me of the plan we put together. That's having someone in your corner, right? Now, there's some questions that arise, I think, when it comes to volatility. And let's just talk about it, all right? I would say right now, and correct me if I'm wrong, you can give me a little head nod proverbially in your car or wherever you're listening to me right now. But you might be thinking, okay, Brad, are we at the beginning of a huge market drop? Are we at the beginning of a recession? I'm going to say something that's going to probably tick you off a little bit, but we have no idea. Now, I know how dumb that sounds in context, but understand this. I could give you every stat in the book and have you here with me for an hour listening to me rattle off a bunch of empirical data as to the 6 different recession indicators, how many of those need to like ping red before we actually kind of say, okay, we're going to go into recession. But I'm going to remind you of this, and this is also going to sound kind of on the nose. Does it matter? If you're managing your assets for the long term, does it matter? Friends, we just went through a recession not that long ago. It depends on how you look at things in terms of where you're investing your world. A recession could also mean opportunity. Volatility can be opportunity. But what we do know, and I'll say this, that buying and holding helps you understand and helps you buy more shares or more equity or more wealth, however you want to put it, into your future. Now, as I said a minute ago, I want to talk about this context of long term because I might be speaking to someone right now who's in their 50s or 60s even. And I want to share this openly because when me, as a financial advisor, someone who builds wealth, as a private wealth manager, when I talk about long-term, I'm not talking about you being 25 or 30 and having a long-term time horizon until you're whatever, the national retirement age of 67. That's not what I'm talking about. What I'm talking about is when God calls you back up. Because correct me if I'm wrong, but when you retire, at whatever age you choose to retire, you're not expecting to have a retirement that only lasts a year or two, are you? So if you are in your 50s right now, and let's say life expectancy is 85, is that not long-term to you? Is that not 30 years? Is it not the same context you likely are thinking right now when you're 30 and you're 60? I get that comment all the time. Well, Brad, you say long-term, but I'm 50 years old. I mean, yeah, great. We got 35 years, God willing. So to me, one of the ways I say this, and it helps bring context into volatility and what you're seeing this week or what you've been seeing here a little bit this summer, is understanding that a retirement date or some date you have in your head about leaving work or selling your business or whatever it might be is just a end of a chapter and the start of a new chapter. Now, as corny as that may sound, it's true. Because barring a national holiday, if you retire on a Friday, markets are open Monday. Am I wrong? And so understanding that it's not just, now this also brings another question up to many, that it's like the old notion, the rule of thumb, that you're supposed to get more conservative as you get older. And I've said this many times before on our show that I'm not saying that's right or wrong, but I want to bring some context to it before you just start thinking that that's gospel. And what I mean by that is this, is growth is different in different ages and stages of your life. For example, when you're 50 or 60 and you're getting into retirement, we may not be trying to grow the assets like we were when you were 30 because we want to grow wealth and we are contributing because there's different factors going on in that time of life, correct? What we'd be growing, quote unquote, air quotes here, the account for is to fight off purchasing power risk, to make sure we keep pace with inflation, to make sure that the $1 million that you might have between your IRAs, your 401ks, your deferred comp plans, your other monies is still $1 million purchasing power when you're 80 years old. So we have to help shift the mindset of how we look at things when it comes to volatility.
Stay connected. Get frequent updates on the show. Follow Brad Barrett and Make Your Money Matter on most social media platforms. And catch full episodes of Make Your Money Matter streaming now on our YouTube channel. To schedule your no-obligation appointment, go to onecapital.com or call 805-410-5454.
I want to bring something up because I think it's some good context here to step away from this just on-the-nose discussion about volatility. Our firm, our investment committee here at One Capital Management actually wrote a folio that we sent out to our clients about a week or two ago. It was for the second quarter statements that we were sending out. And so if you're a client, you might have read this. If you're not, I want to share this because I really like the research that we did on this. And it was actually a study that was done in the 60s. And we went back and looked at this because in the 60s, there was a belief of among some weather statisticians that long-term weather forecasts could be predicted by analyzing historical records to see what happened when conditions were similar. Now, there was a meteorology professor at MIT, this guy named Edward Lorenz. He wasn't buying it. Basically, he was running a computer program at the time to test various simulations, and he discovered that rounding a variable, even the slightest amount, like say from 0.506127 to just 0.506, just change the tenths, if you will, drastically changed nearly 2 months of weather predictions he'd simulated. Now, Lorentz concluded that long-range weather forecasting was therefore what he called a fool's errand. It was impossible to measure the scads of variables, even tiny ones in nature, that might cause things to change. He initially termed this sensitive dependence on initial conditions. Now later, presumably for those of us unable to or equipped like myself to attend MIT, he coined it the butterfly effect. We've heard of this before, have we not? Now, famously, he described it this way. When a butterfly flutters its wings in one part of the world, it can eventually cause a tornado in another. Now, I bring this up because, like nature, the global financial markets are complex and they're also interconnected. And singular and concise actions can actually have much broader implications, including things like causing economic hurricanes for industries not directly involved. But for us as individuals, our actions can have broader implications. Said differently, how we choose to react to what we are seeing in volatile markets currently can have broader implications to your retirement as a whole. Now, I know in saying this, I'm not expecting you to be like, oh, okay, Brad, yeah, I have no fear. I get it. No, I understand the questioning about what's going on, about interest rates, about the Fed Open Market Committee holding and some of the news data about employment and stuff like that came out last Friday. Like, these are common things that are going to come out to the marketplace. Now, here at One Capital Management, our portfolio management team and our investment committee is heavily educated and designed to help go through the fundamentals of what we're seeing in the market. And I want to say something about the market here because this is really, really important as well. And I've shared this with many of my clients. We've shared it on some of our town hall calls. I've even likely shared it here on our show. But the S&P 500 is a weighted index. Said differently, the bigger you are, the more weight you carry in the index. Now, for most of my career that spans nearly 2 decades, the consortium of companies in the S&P 500 that were heavily weighted really didn't get over 10% of the entire index. To give you some context where we're at today, that is near 40% of concentrated companies. Companies you know about. We've written about them, the Magnificent Seven. We've written about them, the 10, the 11. And these are all the Apples, the Amazon, the Netflix, the Googles, the Microsofts, the Nvidias. All great companies, mind you. Just making sure we don't want to own them in concentration. Over the past, I would say 6 months to a year, speaking about one holding we do own, which is Nvidia, and I'm not suggesting anyone buy it or sell it or anything today. I'm just talking about the position openly here, that we like a lot of those positions. In fact, we wrote an article in our folio, I want to say 2 quarters ago now, talking about the Magnificent Seven and sharing that we own about 6 or 7 of them. The one we didn't own was Tesla because we don't particularly enjoy the fundamentals that we see, the price to earnings, things like that. I digress. What I'm trying to say here is we can own the companies. We just don't want to own them in a concentrated position because things like this, little blips in the market, volatility, Buffett saying he just sold a bunch of his shares in Apple, things like that happen can turn things around if you're too heavily weighted in one position. And I know this is going to be boring, and I know how I'm going to say this, and you're probably going to roll your eyes at me, but diversification is the way to go. It's been proven. Now, I'm not going to go through all the empirical data on that, but just take a look at understanding weathering volatility. And remember, if you're a client of ours here, or you're working with a manager and you have a proper plan and a well sought out asset allocation and diversification, we're going to get through this. It's the long-term view. And so the idea here is to make sure we don't kind of let the noise in. I've said this before, but it's a good analogy and a good parable, if you will, that remember that it's not the water around a boat that sinks a ship, it's the water that gets in. So it's important that as we are, getting fed whatever things that we're reading or seeing or watching or following on social media, that, filter it. Talk with your counsel, talk with your advisor. It's just an important thing, I think, for everyone to glean into, especially during times like this. And I want to round out today's discussion with the idea of staying the course. Funny little story. About 2 hours ago, I walked in the office here and my portfolio management team, this was early in the morning, was already here as usual trading. And we were kind of, smiling at each other as I walked in. I got about 4 or 5 review meetings with clients today. And I kind of jokingly or quipped to them saying, hey, got a couple review meetings heading in today. Any ideas, any talking points, anything you're seeing in the markets? This is my analyst team, right? And nearly all of them yelled out, stay the course. Now, we kind of joked about it because we know how mundane or simple that might be. But friends, even us in here are saying that, and I want to share that with you. I'm not trying to be laboriously boring when it comes to this, but stay the course is really important. And I'm going to end with this, with context. I've shared these stats before, but I think it bears repeating. That, over the past 40 years, we've had 6 or 7 recessions. We've had 6 or 7 bear markets. We've had over 40 federal rate hikes. We've seen a dot-com bubble. We've seen 2 50% stock market crashes. That was actually in the last 20 years, 25 years. That's an anomaly, friends. We've seen 12 or 13 US-involved wars, from political to geopolitical environments. We've seen a global pandemic 4 years ago. We've seen presumably impeached presidents and the great financial crisis of 2008, which was part of that 50% stock market crashes. We've seen all that in the past 40 years. So for us to disrupt our plans over 4 days of market volatility might seem short-sighted. I can't tell you through this medium whether that is or is not. You need to discuss that with your advisor about your specific situations, but it's important to think of the context. There's also a stat out there that there is, for every recession, every bad year, or what do you want to call it, there's about 6 good years. Now, when I say that stat over the past 100 years in the market, remember this: it doesn't mean when you have a bad year, you're gonna have 6 straight good years. It's the averages. And it's important for us to look at this year as a whole. Markets have been up. So like I said at the top of the show, we're giving back a little bit of the gains thus far as we figure out what's going on here and why the disruption. And as everyone has always say this, okay, make sure you have someone in your corner to talk to. Hey, I hope you enjoyed that today. If you did, before acting on anything discussed today, remember to speak with a financial advisor near you about your specific situation. Or again, if you'd like our help, you can reach us at 805-410-5454. And until next time, always remember to make your money matter.
The information in this show is educational and general in nature and does not take into consideration a listener's personal circumstances. Therefore, it is not intended to be a substitute for specific individualized financial, legal, or tax advice. To determine which strategies or investments may be suitable for you, consult the appropriate qualified professional prior to making a final decision.